I saw a story just this week that said consumers are now the 80% lowest rungs of consumers now have less money in their bank accounts, less cash coming in, less cash equivalents than they did before the pandemic. Like we've spent off that 80% is spent off.
Our data doesn't. We can go into that, but our data doesn't show that.
Okay, what does your data show?
So if you take the cohort of customers that existed in 2019 to early 20 and run them out to today and look at them by size of holdings, their checking and deposit accounts, they're actually still up significantly from that, especially in the lower cohorts. The ones that are down are the upper cohorts. And why is people have to remember why people have money in a bank is there's transactional cash and there's cash in excess of transaction investment cash. When rates went up, a lot of that moved. So if you look in the upper cohorts, people had 100,000, 150,000, 200,000, they're actually down pre-pandemic. But that's people moving for the yield of money market funds or direct treasury. But the people who have the money going in and out, they're higher by about. One example I'll give you is people had at that time between 5 and 10,000, average 7,000, and now they're sitting on 21,000. The same customers years later.
Okay, so that tells me that the consumer is going to be really strong. If you're right and these other data points are wrong, the consumer still has a lot of excess cash and maybe. That's
what they had. But remember, a lot of people said in early 22, a lot of people were saying they'll be out of their cash by mid 22. Yeah. And then mid 22, they're going to be out of cash by Christmas. It just hasn't happened. That doesn't mean that it is coming down. And if you look at the cash flow of especially the lower median income consumers, you're starting to see them net cash flow out a little bit. And that's the whole thing. California delayed their taxes that came a little later this year. There's just the gas prices are up. So you're seeing that, but it's kind of cuspy, on the edge of it. But, that balance would have been up. And basically it peaked probably in April of last 23. And it's been bouncing around. It accretes, but even mid-month in September versus the 4-week moving average mid-September versus the month before, flattish it down 1%. And so it's moving down. The perception is it moved out. It quite hasn't done that yet. The higher end deposit industry moved quickly, and that's why deposit industry are down 8% year over year. Okay. If you look at the deposit in the industry, they kind of grew to a 5% level. They shot up, and they're still above that trend line. And that, as monetary accommodations take it out, that'll happen. But that is more higher end corporate borrowers, wealthy people pulling the money out and finding another alternative, not the transactional cash. That stays pretty constant.
All right, let me throw another couple other issues that could mean that inflation's not over. You look at higher energy prices, and that translates into higher gas prices. Housing costs may not have bottomed out. We may see them picking up again, especially with higher mortgage rates, the highest in 23 years. You can look through a lot of different issues and say, okay, maybe we're not done with inflation. What's your answer?
They haven't. They got to be careful to make sure they've won. But so look, what drives people's cost, food prices, which oddly enough actually are a little bit of a tailwind right now because they have settled back down. Yeah. Energy prices were that for most of the year and have gone the other way now. So our September data shows for the first month since last year, people are spending more money on debit and credit cards on gas than they did that month from the year before in August and September. And that's because of the recent run up in prices, but it's positive by 1%. That's about 7% they're spending just on debit and credit cards, which is only 25% of the total spending. So it's regressive in who it applies to, but it's less of an overall impact than people think. So rent is real. And so the question is, rents are tipping over in some places, have tipped over in other places, but they've got to stay where they are because there's 130 million households in America, round numbers, 60 have a mortgage, 60 don't, and that's all rent. And so that is the more meaningful question about what's the impact on households where rental prices go. Then the people with the mortgage are locked in 90% are locked in at very low rates. And so they're not having a change in household carry costs, maybe for repairs and stuff. So the question on rent and what you've seen is rent, I think it's on its 18 months under the one of the data sources, sort of declines, but it's not broken yet. It's still relatively expensive and that's got to catch up. And that's the one I think you have to watch.
And the problem is with a lot of these things, these are supply side issues that the Fed can't control. Yeah. And its toolboxes, again, you're using pretty blunt instruments to try and beat that stuff down.
Yeah, remember the Fed has two jobs: price stability and employment. Employment's very strong, and the price stability they're after, but they don't have the ability to permit a housing development, and that's what caused. So when you work on some of these center city groups, whether it's here in New York or whether it's in Charlotte or Boston or you pick the place. Workforce housing is, in shortage in a lot of cities. That is not something affect it matter. The rate structure makes it more difficult to do, but that is a question of permitting and pace of getting those projects built. That is not in their control. And that's one of the difficulties. They'd have one thing to push on and it doesn't affect that. Now, interesting enough, new houses are being sold and people aren't moving, and all that will settle out when people get more used to rates, because the unusual time is now. It was not. It was the last 15 years. The Fed funds rate below 3%, financial crisis through the really recently. That's the unusual time.
Is that gone forever?
I don't know. I mean, our team at one point published, Candace Browning, Platt and the team, they published a research report that said we're at a 5,000-year trough in rates, and I tried to figure out
5,000.
I tried to figure out how they calculated the first few thousand, but the view was you had this constant rundown, and so you've been at a very low level on a historical thing. So my guess is we're back in for a higher rate structure.
Okay, let's go back to the recession call, because as you mentioned, you guys thought that there was potentially going to be a recession the end of this year. You pushed it out, and now you're saying no recession, or we're going to see a downturn sometime in 2024.
Yes, our strategies are no recession, very slow growth, 0.5% annualized GDP growth, second and third quarter, so it slows down, troughs, and starts coming back out, gets back up to above 1% at the end of next year, i.e. 24, and then finally gets back to 2% at the end of 25. So this is a low thing.
Gradual. So would you call that a soft landing? Or
that's a soft landing by definition, because it's not.
It's not actually.
Now, the interesting thing is what caused them to change that. It was the consumer early on. What happened, if you're in in 22 fall, heading into in a rate structure and all that stuff, and they're going to push it in, they have to. It's the only way to correct it. The consumer kept going. What's changed now is the consumer slowed down. So that means you've got to now have more risk that you could push the other way. But it pushed it out because the activity of the consumer stayed so strong. That was the surprise of the system, was the consumer stayed strong. What's happened in the last 3-4 months is the consumer's turning around, and you've got to be just as mindful of that turn, I think.
Do you think the Fed sees the same thing that you see based on
we give it to them? So yeah, definitely.
Do you think they think of it the same way?
Well, the question for them is, there's a couple things about not being an economist allows you to have an objective view of some of what but the way an economist looks at price, if you had a price of 100 and it went to 115 12 months later, that's a 15% increase. If the next year went from 115 to 118, that's only 3% increase.
Right, but the consumer still feels the 15%.
You feel the first 15,
right.
And so there's a little bit of this is inflation's sort of a leg measure, but also a measure that is measuring a trajectory as opposed to an absolute. So because the belief is once it's absorbed in the economy, it's absorbed. And so there's nothing, it's the math and a science to it. But I think, they see this data, and I think that's why our projection is they raise rates one more time in November, and they start cutting next year, but they cut 3 times next year and then 4 times the year after. But if you take 575 and subtract 175, that's a Fed funds rate at the end of 25 at 4%.